Hi everyone, very good afternoon. You're watching the newsroom on ET now. I'm Mubina Kabasi. Take you, through a quick look at what the equity markets are up to. And yes, after the massive decline we witnessed yesterday, the markets are once again back in recovery mode, nursing the losses. 0.8% higher for the Nifty and the Sensex. The Sensex has managed to reclaim 40,000, Nifty 11,700. Let's tell you what are the big movers and shakers today in trade. Declining in trade is UPL. This after the news that it's a statutory auditor from one of its key subsidiaries based in Mauritius has resigned. And this really is raising a lot of question marks as to why this has happened. KPMG Mauritius has actually resigned as the auditor of UPL's leading subsidiary. So no surprises that this stock is losing in trade. I think the last time I checked, it was more than 6% gone. Yes, 6.5% declining in trade. Moving on to more stocks in news, and here's an ET Now exclusive. IDBI Bank is in focus. As we told you earlier on the show, and as my colleague Ruchi Bhatia broke, sources within the government are saying that the government is seeking a broad in-principle cabinet nod for the stake sale in IDBI Bank, and they're also indicating that LIC is keen on divesting its stake in IDBI Bank as well. Moving on to more stocks in news, look at Amber Enterprises, a massive rally being witnessed in the stock. Remember, late last evening we had news that the government has banned the import of air conditioners with refrigerants. This is something that will be a boost for companies that do make the product, and Amber Enterprises is higher by more than 7% in trade. They're also going to be holding an investor meet, by the way. They've sent out a notification regarding the same to exchanges. On the flip side, a loser in trade is Mindtree. The company came out with its second quarter numbers. Mind you, the numbers were not that bad. Though, if we look at it, revenues grew in line. Profits were higher than expected, but TCV of deals was lower sequentially. Weakness in top two clients buckets is something that one should watch out for. Especially in the top client, there was a bit of an unexpected decline. That's something I guess one should keep their for their radar. But in general, technology stocks have been taking it a bit easy after that rapid rally that we had seen recently. And then, of course, HCL Tech as well is in focus, again because of the second quarter numbers. Mind you, again, not such a bad set. They managed to live up to what the peers have done. But I guess most of the buying in technology had come in when TCS itself, sort of sounded the gong in terms of second quarter numbers, sort of laid down a path of expectation for the rest of the technology names as well. But let's keep it with Mindtree. Massive selling pressure being witnessed in this counter. I gave you a brief synopsis of what's going on, but let me go across to my colleague Poonam Sani for more.
Well, I would say unlike what we have seen from the other IT players, Mindtree has reported an average quarter, especially in terms of the lowering of the TCV deals. In fact, the TCV of deals did fall, was lower during the quarter to $303 million. This is versus the $391 million QOQ. This is on account of weakness in one of the top client. Besides that, if you look at the overall performance, revenue growth was average at 2.1% quarter on quarter in constant currency terms. EBIT margin performance, however, was strong with margin expansion of nearly around 150 bips on a QOQ basis to 16.6%, and that aided the profitability, which is up 19.1%. If you look at the overall commentary, also management stated that there are a lot of uncertainties. However, they are confident of maintaining the growth momentum in Q3. They would want to wait and watch before getting further visibility. They also mentioned that the travel, transportation and hospitality vertical will take some time to recover. Spends are robust in CPG and technology clients. Vendor consolidation will take place. However, they aim to benefit from the vendor consolidation. Pricing is stable. Utilization has gone up, and that will aid the margins. And also, they mentioned that there has been significant portion of annuity deals in TCV, which is likely to continue. But all in all, a slightly weak quarter, especially on the TCV deal front for Mindtree.
Thank you, Poonam, for that. Well, you're out then from the management of Mindtree, Debashish Chatterjee, the CEO and MD, who believes that the COVID disruption has helped in actually increasing margins, but also said that they were working on this for the past 12 months. Listen in.
See, as far as the margin is concerned, this is not something which is a one-quarter phenomenon. Almost for the last 12 months, we had put together a plan, we had put a program in terms of how do you take the margin to a band which is more appropriate. So what you see today is a culmination of that. Of course, COVID has also helped because some of the costs in terms of travel, some of the marketing costs, those might have gone down a little bit. But having said that, our view is that we are now in a band. We have taken the EBITDA up to 19.6%, and we are going to definitely maintain this band going forward. That's what our plan is.
Okay, well, that's of course Mindtree for you, a big fall being witnessed over there. And HCL Tech, meantime, has as well delivered its second quarter numbers. My colleague Chandra Shrikant spoke to the CEO, C. Vijay Kumar, and CFO Prateek Agarwal and got their take on it. Listen in.
HCLites have delivered a stellar performance. We delivered 4.5% constant currency growth, which translates to 6.4% in US dollar terms. It's almost a perfect V-shaped recovery. And what's even more impressive is our EBIT percentage is 21.6. This is actually a 22-quarter high, right? 5-year high or 22-quarter high, whatever you want to call it. So that's been good. We signed 15 transformational deals. The momentum in the market for modernization and digital transformation services has been great. Our life sciences and healthcare vertical and the retail CPG vertical grew 8% plus sequentially, which is a very impressive performance. All verticals, all geographies, all service lines, all modes had a sequential growth. So it's a very good all-round performance contributed by, of course, some amount of recovery is due to the dip that we've had in the first quarter. But a lot of transition of deals that were done in the previous quarter got done extremely well, which helped in ramping up revenues. A lot of existing customers continue to demonstrate their faith on us by giving us more projects and some incremental work, which all got billed. And of course, Digital Foundation, which is our erstwhile infrastructure services, is a very, very strong, we're ahead of the pack for a long, long time. And the demand for making a robust digital foundation as a basis for digital transformation is a theme that we see in almost every large enterprise. So, of course, all of this, and of course, our employees, last but not the least, they've done an amazing job. They walk the extra mile to keep our clients happy, despite all the odds that they faced. So we're also coming up with the increment cycle. All our employees up to E3 levels will get increments starting October, and E4 and above will get their increments starting 1st of January, which is a three-month lag from the regular cycle. So we are very thankful for everything that's happened. That's what would summarize the quarter.
All right. Well, from earnings delivered to earnings expected tomorrow, HDFC Bank will be delivering its second quarter numbers, one of the first of the largest banks across India. Let's go across to Varun on what we can expect.
Arguably the best private bank in the nation will be announcing its results tomorrow on a Saturday, as they always do. Now it's going to be an interesting number because we already know so much from the recent update they just put out, right? So we know that advances are growing at 16%. We know deposits are growing at 20%. As a result of that, your CASA is holding up very fine. We also know they bought some small loans from HDFC Limited. So it's not surprising that their credit, their ability to grow credit is continuing because they also have one of the strongest deposit franchises. And essentially, if no money is coming in, no money can go out. And HDFC Bank didn't really conduct any equity raise. So they're relying purely on their internal accruals to grow. With all that being said, NII should maintain its upward trajectory, coming in at near 16,000 crore. There might be a slight pressure on profitability this quarter. According to brokers, they're thinking 12,560 crore pre-provision, which is slightly less than what we saw last quarter. And then post-provision, they're thinking around 6,500 crore versus also, again, slight tapering off of last quarter's number. So there are brokers like Nomura, let me just flag that off, which do have more bullish targets. They have PAT of above 7,000, PPP above 13,000, and NII above 16,000. So we'll see where it eventually ends up, but these were the consensus figures I just gave you. Key things to look out for is just going to be the outlook on margins, the credit cost, if there's been any reversal of entries because of the SC judgment, and any restructuring that needs to happen to the pool based on the customers that were opting for moratorium or not. Everything else is expected to be pretty much stable state at HDFC. We'll also be looking out for the provision figure this quarter. They have been elevated lately. Given that we do have a lot of macroeconomic uncertainty, perhaps that trend will continue into Q2.
All right, Varun, thank you so much for that. Okay, moving on, Kenichi Ayukawa, the CEO of Maruti Suzuki and of course IAM's president as well, talks about the signs of economic recovery and of course increase in car demand. Listen in.
We are in the middle of a pandemic and industry is working very hard to maximize production and sales while keeping our people safe. We are closely monitoring both operation and COVID safety in the entire value chain. We are monitoring starting from second and third tier component suppliers to our own factory to logistics to dealer showrooms and workshop, including the safety of our customers. In this scenario, there are some signs of recovery in some segments. Sales in the second quarter for passenger vehicle is positive compared to the previous year, but still lower than Q2 of fiscal year 16-17, which is 5 years ago. Sales of two-wheelers have been almost equal to last year and lower than fiscal year 16-17, which is 5 years ago. The commercial segment had a big growth of 20% and sales were below financial year 15-16, which is 6 years ago. Sales of three-wheelers saw a drop of 75% in the quarter, and it's behind by many years. In passenger vehicles and two-wheeler, we can see good festival demand and we are trying to fulfill it.
All right, well, on that note, we'll take a very short break right here on the show. Okay, welcome back. You're watching the newsroom on ET Now, and here is a big ET Now exclusive. We are joined by Mr. Jay Shroff, the global CEO of UPL, and this is an important interview. Remember, the stock price of UPL has cracked on account of the resignation of KPMG as an auditor to one of its material subsidiaries. Mr. Shroff, really appreciate you joining us today on ET Now. Now, I know you've given a clarification with respect to this resignation, but clearly the market seems to be still troubled by this resignation, by an auditor. If you could just talk us through why they have resigned, if there were any contentious issues that were raised with respect to the subsidiary, because, the stock is tanking, and on an intraday basis, it almost fell by 9%.
Yeah. Thanks for that. So basically, UPL has been the fastest growing company in our industry for the last 10 years. Recently, we made a large acquisition about 2 years ago, and we doubled our business. Most of our overseas subsidiaries are audited by KPMG, all the material subsidiaries. And in India is also audited by KPMG India. and that is the holding company. While our business has been growing substantially, and the number of the workload for the material subsidiary in Mauritius has also more than doubled. Mauritius subsidiary was of KPMG was not able to cope with the workload, and that reports not to India, but that reports to South Africa. And being a small island country, we've always had an issue, and KPMG India agreed that they will oversee the audit for the Mauritius subsidiary rather than reporting into another arm of KPMG. So actually, we still remain with KPMG. KPMG has not resigned as an auditor of UPL. We just asked, UPL as a company asked KPMG to either increase the capabilities in Mauritius to cope with the workload or resign. And so we asked them to resign. They didn't resign voluntarily. UPL is, I'm sure it's a pride of KPMG's audit within the audit companies they audit. So I'm sure they're very, very happy to keep us as a client, and there's no accounting issues or any other issues which why anybody resigned. It was our request that if you're not able to give us our books, audited books on time so that we can close our quarters, we better put somebody who has more resources to be able to do that.
Mr. Shroff, essentially KPMG was not being able to deliver as per your timelines. That's basically what you're saying. They were not able to cope with the workload, and that's the reason why you requested KPMG to sort of resign and give the charge.
No, KPMG remains the auditor. KPMG Mauritius was asked to resign, and not KPMG India. Right? KPMG India still are auditors.
Still the auditors. Okay, understood. Is this increased workload resulting in sort of... Yeah, okay. Is this increased workload resulting in any sort of increased working capital needs, Mr. Shroff?
No, it's just we have we operate in 130 countries. There are a lot of subsidiaries. Business is growing. We have to meet the quarterly board meeting and SEBI requirements. A lot of manpower needs to be allocated to make sure the audit's done properly, and there has to be allocation of enough resources. Otherwise, we always were fighting in the last few days before the board meeting to close and get the audit book signed, and it was getting delayed. And therefore, we said India is a huge operation for KPMG, and they should oversee it, and they have enough resources to allocate, because Mauritius reports to South Africa within their organization. And I guess Mauritius is a low priority for KPMG South Africa, maybe. I don't know what is the reason. But we couldn't get them to deliver on time. So we asked KPMG India to take charge, and we had a board meeting, and we agreed that this was we should make sure we have enough resources there.
Got it. Okay. All right. The reason actually why I ask you this is because, like you mentioned, right, you made an acquisition 2 years ago. Business as well has increased significantly. But, debt as well, I think is something that, the street would like to understand. And that's the reason why I asked you about, the working capital, about the debt. So if you could just shed some light on that, what's the current debt level? Is it going to be paid down starting this year?
We already paid down a substantial debt last year. We reduced it. We've already committed that we will reduce the debt going forward. And UPL has always maintained a very conservative balance sheet. So we are quite comfortable that we will be able to meet our guidelines on the debt reduction.
All right. Well, Mr. Shroff, thank you so much, for joining us today. It was important that we get in this clarification from you. So, Mr. Jay Shroff clearly stating that, as work increased, in some of the key subsidiaries, and most of which, by the way, are audited by KPMG, in particular the Mauritius subsidiary, KPMG Mauritius, was not being able to keep up with the workload, and that's the reason why UPL asked KPMG Mauritius to sort of step down, because of their inability, to keep up with the workload. So important clarification coming in over there. But very quickly, just before we wrap up the show, volatility is an intrinsic nature of the stock markets, and every time the indices drop, investors get into a state of panic as they worry about the loss of their hard-earned money. On this edition of Nivesh Ke Funde, our special investor education series, we guide you on what to do when the markets fall. Take a look.
Hello and welcome to Nivesh Ke Funde. Well, we all know that equity market never goes up in a straight line. Equity market by nature will be volatile.
So true, Nikunj. It's only when the markets fall drastically does one get worried about one's hard-earned invested money.
So when prices are down, it is important first to stay calm, maintain your financial discipline, and stick to systematic investment plans via mutual funds.
Yes, the fall in the equity markets is a short-term phenomena, and it's very important to stay focused on the long-term goal that you have in your mind.
So Aisha, human mind is programmed to panic. We tend to get in a freeze mode when markets go down and when stock prices are in a free fall. But it is important not to panic, because the haste will really cause you long-term pain, and it will affect your wealth creation journey.
It's important to remember the golden rule of investing in the markets: buy low and sell high.
Well, after all, you're investing in market because investing in equity is nothing else but buying future pricing power. And investing via mutual fund is always the best and the easiest way to buy future purchasing power.
Exactly, Nikunj. Might as well buy more when the markets are low and reap the benefits when the markets rise again.
So next time when markets fall, do not panic. Stick to your financial planning, which is discipline, diversification, and having a long-term view. Well, that's it on Nivesh Ke Funde on the Times News Network.